Risk management and insurance. Protecting your finances and building security for the future. Introduction. Life is unpredictable. Emergencies, accidents, illness, and other unforeseen events can threaten your financial stability. Risk management and insurance are essential tools that allow you to prepare for uncertainty and safeguard your wealth. For young people aged 18 to 35 seeking to start a career and lead financial literacy in schools, understanding risk management and insurance is vital because it helps prevent financial setbacks from unexpected events. It teaches responsible planning and financial discipline. It equips you to guide students on protecting themselves and their families. This module will cover what risk management is and why it matters, different types of risks and how to assess them, understanding insurance and its importance, types of insurance relevant to young people, practical strategies to reduce financial risk, school application for teaching students about risk and insurance. By the end, you will have the knowledge to protect yourself, plan for the future, and teach financial literacy through coffee clubs. Section 1. Understanding risk. 1.1 What is risk? Risk is the possibility of loss, damage, or any event that negatively affects your finances, health, or well-being. Risk is inherent in everyday life. This includes driving a car, starting a business, or even choosing what to eat carries some degree of uncertainty. 1.2 Types of risk. Financial risk, loss of money due to unexpected events or poor decisions, e.g., debt default, investment loss. Health risk, illness or injury that leads to medical expenses or loss of income. Property risk, damage to physical assets such as a house, car, or personal belongings. Liability risk, legal obligations arising from accidents, mistakes, or negligence. Business risk, uncertainties in income, market changes, or operational challenges. Section 2. What is risk management? Risk management is the process of identifying, assessing, and controlling risks to minimize financial loss and protect assets. It involves planning for the unexpected and using strategies like savings, insurance, and diversification to reduce potential negative impacts. 2.1 Steps in risk management. Identify risks, recognize potential threats to your finances, health, and assets. Example, a student planning to study abroad may face tuition increases, currency fluctuations, or health emergencies. Assess risks, determine the likelihood and impact of each risk. High probability, high impact risks require immediate attention. Prioritize risks, focus on risks that could cause the greatest harm. Mitigate risks, use strategies to reduce or transfer the risk. Example, buy insurance, create emergency funds, or diversify investments. Monitor and review, risks change over time. Regularly reassess and adjust strategies. Section 3. Introduction to insurance. 3.1 What is insurance? Insurance is a financial safety net. It is a contract between you and an insurance company, where you pay a premium, and in return, the insurer promises to cover specified losses or damages. Key principles. Premium, the amount paid regularly for insurance coverage. Policy, the legal contract specifying coverage details. Deductible, the amount you pay out of pocket before insurance covers the rest. Coverage limit, maximum amount the insurer will pay. 3.2 Why insurance matters for young people. Protects against unexpected expenses, medical bills, accidents, or emergencies can be financially crippling. Secures future income, disability or life insurance ensures family or business continuity. Encourages financial discipline, paying premiums encourages budgeting and planning. Supports long-term goals, protects investments, education, and career aspirations. Section 4. Types of insurance. 4.1 Health insurance. Purpose. Covers medical expenses for illnesses, injuries, and hospitalization. Benefits. Reduces financial burden from medical bills. Provides access to better healthcare. Tips for young people. Look for student or entry-level employment plans. Compare premiums and coverage benefits. 4.2 Life insurance. Purpose: provides financial support to dependents in the event of death. Types. Term life insurance covers a specific period, affordable, ideal for young earners. Whole life insurance, permanent coverage, builds cash value, higher premiums. Benefits: protects family, pays off debts, ensures financial stability for dependents. 4.3 Property insurance. Purpose: protects physical assets like homes, vehicles, and electronics. Types. Homeowners/renters insurance covers property damage or theft. Vehicle insurance covers accidents, theft, and third-party liability. Tips for young people. Insure high-value items or vehicles. Compare quotes for cost-effective coverage. 4.4 Disability insurance. Purpose: replaces income if you are unable to work due to illness or injury. Benefits: provides financial stability. Allows focus on recovery without worrying about expenses. Tip: start early, premiums are lower for younger individuals. 4.5 Travel and education insurance. Travel insurance covers emergencies, lost luggage, and health issues during travel. Education insurance protects tuition and school fees in case of unforeseen circumstances. Section 5 Risk management strategies beyond insurance. 5.1 Emergency fund. Save 3 to 6 months of living expenses. Reduces the need to borrow during financial shocks. Supports independence and financial security. 5.2 Diversification. Spread investments across different assets, stocks, bonds, real estate. Reduces the impact of a single investment loss. 5.3 Budgeting for risk. Allocate funds monthly for unexpected events. Include insurance premiums, emergency savings, and contingency plans. 5.4 Healthy lifestyle and safety measures. Reduces health risks and insurance claims. Promotes long-term financial and personal well-being. Section 6 Common mistakes to avoid in risk management and insurance. Underinsuring, not having enough coverage can lead to financial hardship. Overinsuring, paying for unnecessary coverage increases costs. Ignoring policy details, not understanding exclusions, deductibles, or claim procedures. Delaying insurance, waiting until a risk materializes often results in higher premiums. Neglecting emergency funds, relying solely on insurance without savings. Section 7 Teaching risk management in schools. Coffee Hub leaders can help students understand the importance of managing risk. 7.1 Activities to teach students. Risk identification game, students identify risks in everyday life. Insurance role play, simulate claiming insurance for health, property, or travel emergencies. Emergency fund challenge, students plan a small savings account for unexpected events. Case studies, discuss real-life scenarios of risk management success and failure. Needs versus wants exercise. Teach students to prioritize essential coverage over luxuries. 7.2 Key lessons for students. Planning ahead reduces stress. Insurance and savings protect dreams and goals. Financial literacy includes understanding how to prevent and respond to risks. Section 8 Real-life case studies. Case Study 1 Health insurance saves a young professional. Amara, 25, fell ill unexpectedly. Without health insurance, medical bills would have depleted her savings. Luckily, her student health plan covered most expenses, allowing her to focus on recovery without financial stress. Case Study 2 Life insurance protects dependents. John, 30, purchased term life insurance after starting his career. When he unexpectedly passed away, the insurance payout helped his family pay off debts and continue living comfortably. Case Study 3 Diversified investments and emergency funds. Lena, 28, invested in stocks, bonds, and a small rental property. She also maintained an emergency fund. When her car was stolen, the combination of insurance and savings covered the loss without affecting her financial plan. Section 9 Key takeaways for young people. Prepare for the unexpected. Life is unpredictable. Risk management ensures financial stability. Insurance is essential, protects health, income, property, and family. Diversify strategies, use savings, insurance, and budgeting together. Start early. Young people benefit from lower premiums and long-term financial security. Teach others. Use coffee clubs to help students understand risk and protection. Risk management is not just about avoiding loss, it's about empowering yourself and others to achieve goals confidently. Conclusion. Risk management and insurance are cornerstones of financial literacy and personal security.